Hello, dear investors. Tower REITs are among the REITs with the highest growth rates in earnings and dividends, Amazon-like, except they pay dividends. This is why dividend yield in the past has been low. However, in the new age of high interest rates, stock price also of Tower REITs declined and dividend yields went up accordingly to record levels. Are Tower REITs a good investment right now, and which REIT or which Tower REIT is my favorite? I will tell you in this video. My name is Thorsten Tiet. It's about investing in quality stocks to profit from long-term capital gains and growing dividends as well. So let's go and start our screener. And we have a lot of REITs. You find all the REITs. If you add REIT or select REIT here in the industry group, then you see there are tons of REITs, more than 140. Most of them of the United States. We are interested in Tower REITs, and there exist 3 Tower REITs, and we will focus on American Tower and Crown Castle because SBA Communications is a dividend yield right now of 1.7%, which is not that high. In contrast, Crown Castle 7.1% and American Tower 4%, both on record level. I already told you that in the past there's very dynamic growth in this REIT industry. You can see it also if you look at the matrix, especially American Tower within the last years on average. Dividend increased by 20%, but we can already see a slowdown. Within the last 5 years, average was 16%, but now it's still about close to 10%. Crown Castle doesn't pay dividends that long already. It's 8 years compared to 10 years for American Tower, and their dividend growth is not that high. But dividend yield, absolute dividend, is 7.1%. We can also see that it's on record level. If we go to the dividend alert, here you can see 7.1%. It's much more for Crown Castle than you got in the past, and the same is true for American Tower, also on record level, although a little bit lower. We have also nice earnings. We have very stable earnings, stable dividend payments. You can see it here on the stability matrix. And we also have not that dynamic growth, but still good growth regarding funds from operations, increase of 12% within the last 10 years on average, and about high single-digit growth for Crown Castle, a little bit less growth, but for both companies the growth rates decline. What's also interesting is here we see the fair value matrix, which are out of the box, by comparing 10-year average with the current valuation on different multiples, like funds from operations, adjusted funds from operations, operating cash flow, sales and dividend, and everything points into the same direction and telling you that from a historical point of view, both stocks are cheap. They are cheap, of course, because we have capital losses. You see it here. Last year, especially, was not very good for REIT investors. Crown Castle lost within the last 12 months more than 40%. And close to 30% American Tower, but we see in the long run we still have capital gains in the long run, although not that high for Crown Castle. And what's the basic situation with Tower REITs right now? Of course, we have high interest rates. That's the number one reason. And high interest rate offer an alternative to high dividend yield stocks like these. First, and second, they are a burden for the companies themselves because REITs are financed by debt. They have interest-bearing debt, and you can see it here, and they need to pay interest for that. This is American Tower right now, and you can see here that they need to pay right now 1.3 billion just for interest. But you need to be aware that the debt does not go up, or the interest rates for a company don't go up when the Fed raises interest rates, or when the market raises interest rates for treasury bonds or something like this, because they have their own bonds, they issued their own bonds, and they have maturities, and these maturities, so mostly they stay fixed, and it's just that if a bond matures and they need to issue a new bond, that this new bond will has to pay higher interest, or has higher interest rates, and then it is an additional burden. And for example, in the case of Crown Castle, there's only till 26 2 billion of debt which matures. So let's look at Crown Castle and get rid of all these. And it's only from 28.5 billion, it's only 2 billion of debt which matures within the next 2 years and 2 months. So you see that it is the interest rate for the company don't go up suddenly. It goes up slowly. And furthermore, when interest rates go up, or when consumer prices increase, which goes hand in hand, then some contracts of these REITs dictate that also the rent goes up. Their clients have to pay. Especially in the case of American Tower, for example, for the international contracts, they are linked to inflation. So this is a compensation, at least for part of rising interest rates. In general, I am not that worried, because I think that we have times of high interest rates and times of low interest rates. And it always changes after some years. And it will not stay up like this on 5% or 5.5% in the United States. And for me, it is kind of anti-cyclical investment. And right now, the mood is bad on the stock market for these kind of stocks. So you could buy them right now when the mood is bad, then keep them. And when the mood gets better because interest rates go down, then you could theoretically profit from capital gains. What else in this industry is important? We have a tendency of additional margin pressure, not only by rising interest rates, but also because this mobile cells get a little bit more important compared to towers, because in dense areas you cannot place towers, but you place mobile cells, and towers have higher margins because you can easily rent them to different multiple carriers. But you create one tower and you have 3 tenants, for example. In the United States, it could be T-Mobile US, Sprint, AT&T, Verizon. We have these 4. Although Sprint does not exist anymore, but the contracts still exist. And this is an additional burden, consolidation. So less tenants, less multiple contracts on one tower. You don't earn that much. In the United States, I think consolidation is finished right now. But there are still contracts, especially for Crown Castle with Sprint. And when these contracts expire, they will not be renewed, of course. And this leads to, especially for Crown Castle, to declining margins. And you can see declining margins, operating margins from 36% to 33%. And also declining revenue based on estimates. So revenue should drop below 7 billion. And right now, US dollar, right now it's 7.15 billion. So this puts additional pressure on the stock, of course. On American Tower, things look better because we have here growing operating margins and growing revenues according to analysts. So this looks much better. Also, thanks to diversification in regions. So American Tower makes about 56% of their sales or turnover in the United States, and the rest is spread or the rest is done across a lot of different countries mentioned here. And it's a very, very long list. Compared to this, Crown Castle makes all the revenues in one state, in the United States. Of course, you already guessed it. And what else? And there's often Starlink as a kind of disruption, possible disruption of the tower REIT business. As far as I know, it's not that bad or not that dangerous a situation, because Starlink is not developed to disrupt conventional mobile tower REITs, but it is done to provide internet to regions where there's no fast internet available so far, and it scales rather badly compared to conventional technologies. It means it's not possible to put all the traffic away from tower REITs and using satellites for this. It would be too much. It would be, the satellites would be overcharged, and we still have this latency problem. So they are not, they are designed to how to say in English? They are designed as how to say in English? As a supplement, I think. As a supplement. All right. Yeah, exactly. As a supplement of conventional strategy, and not to replace him. My English will improve. The more videos I do, the better I get. I promise you. Okay, so that was Starlink. And now let's have a look at the stocks, or that was the general picture about tower REITs, what puts pressure on the prices. And what's interesting right now is the difference between these two stocks, because I promised you I will pick my favorite. And the high dividend you have already seen, it is Crown Castle. But if you look at the multiples, we will also see that Crown Castle is much cheaper than American Tower. Let's compare both here. And then you see that in the past, they were on the same level, at least for a long time. Here between 2019 and 21, American Tower was already more expensive. But right now we are here, and we have a multiple based on adjusted funds for operations. American Tower is 16 and Crown Castle close to 12. So Crown Castle looks much cheaper, but interestingly, if you look at the estimates, then you see that American Tower, the multiple goes down, and Crown Castle, the multiple goes up, because analysts estimate that American Tower will increase its funds for operations and adjusted funds for operations, and regarding Crown Castle, it will decline. So we see that in 26, we will have the same valuation based on the current stock price. So, and if you are a long-term investor, this is a strong indicator that you should prefer American Tower, because the outlook is much better. I already told you why. This special burden of Sprint is mainly on Crown Castle, and American Tower is better diversified by region than Crown Castle. So for me, American Tower seems to be the more interesting stock. We could make valuation also, if you look at the fair value here, and we can take the adjusted funds for operations. And this is also a trap. These stocks, both of these stocks, could be a value trap if you buy them with not realistic expectations. So let's see here. And if you take the fair value out of the box, then these stocks look highly undervalued, with a fair value of 100 about 150 US dollar for a Crown Castle compared to 88 US dollar current stock price. So this is a crazy, this gives you a crazy capital or yield expectation, especially capital gains in the short run. But this doesn't hold true. It doesn't hold true because we see that the growth of the company heavily decelerates, and it's not that growth anymore. You can also see it visually. Here we have growth, and here we have degrowth. So the valuation must go down of this stock because the outlook is just that bad. And I would be very careful, or I am very careful, if I evaluate such stocks. So as a strategy, I do is to tell myself, or a defensive strategy, if I evaluate or create or determine the fair value of such stocks, which considerably dropped, is just to say, okay, I think the stock market is right. This company now has problems, and I think that the average price earnings of 2021 is much too high. I think the stock market is right now. He makes a value of 11.6 only, or he applies a multiple of only 11.6, and now we have the stock fairly valued by definition because the stock market is right. And now you see that the annual yield to expect within the next 3 years and some months is just 5% for this stock, which is really, really low because we have no growth here. We have only dividends. We even have capital losses because the fair value goes down, because the funds from operations go down according to analyst estimates. If you look at American Tower in contrast, you see that the funds from operations go up or should go up. And we also have here this crazy or strong undervaluation out of the box, fair value of 214 compared to 100, closer to 160 current stock price. What we do is basically the same. We apply the same logic we did to Crown Castle, and we lower the price earnings to the price earnings of the market, which is still higher, we have seen already, than Crown Castle, but below the average of the last 10 years. And then we get a picture which looks like this. And here the fair value goes up because funds from operations go up, should go up. You already got it. And now we have an expected yield. And I just take this one because here analysts get more optimistic that earnings growth should even accelerate. I go only like this. I'm a little bit more careful, or I could also add these valuation lines and then make a little understatement like this. And then we have an annual yield of 10%, which is double as much as Crown Castle. And here we have not capital losses, but we have expected capital gains. So you see why I prefer American Tower to Crown Castle, especially as a longer-term investment. First, because it is an anti-cyclical investment. I assume that the interest rates go up in the future again. It's just a question of 1 to 3 years. Look at the box plot of the Fed. It should already happen in 2 years, should be already considerably lower. We don't know if this happens like this, but it should be. It's a target of the Fed. And second, you see that American Tower is much more attractive, is better positioned, and this translates into more optimistic analyst estimates. So this is my guess. What's your guess? Please add some comments below. Did I miss a certain point? Happy to discuss, and see you again in the next video. Bye bye.